Hey everybody, Ed the Trainer here. Wanted to touch base with you on the aspect of borrower credit versus yield spread premium. There's a lot of confusion about which is which and what's the deal with borrower credit, yield spread premium. For those of you who are brand new to the industry, yield spread premium was the idea of charging a borrower an interest rate higher than where they qualified with their lender at their par rate based on their down payment, their credit qualifications, all of the aspects of loan qualification. But instead of giving them the rate that they're qualified for, let's say a 30-year fix at 3.5%, instead the borrower would be locked in at a higher rate, 3.75, 4%, creating a spread between the rate they qualify for, their par rate, and the rate that they're actually locked in with at the lender. The greater the spread, the greater the premium that's generated and used in the past under yield spread premium as compensation typically for the loan originator making the loan. But in today's mortgage world, as of the recent changes with the Federal Reserve's final rule on loan originator compensation, that spread is now the same mechanism, but provides the borrower a credit to subsidize closing costs. So this credit is used to defray some of the closing costs for that borrower directly, requiring them to bring less to the table. An example of this, if you're unfamiliar, if you don't quite get it, would be similar to going to the grocery store and purchasing a product that gets an instant rebate at the checkout counter. Imagine in the olden days if that checkout clerk was the only one that was aware of the rebate being given by purchasing that product. And instead of making the borrower, or the consumer in this case, aware of the rebate, rather than saying, congratulations, that box of Raisin Bran provides a $1 rebate back to you and cutting that off of your grocery bill, what if the grocery clerk allowed you to pay full price and took the dollar out of the till and put it in their pocket as compensation for themselves? In the old school days of the mortgage lending industry, yield spread premium worked in a similar fashion. A mortgage broker created loans and locked rates and terms outside of the borrower's awareness. The borrower wasn't certain where they qualified, and oftentimes the broker could pad their compensation, their commission, by locking the rate at a higher rate than where the borrower qualified. In today's mortgage world, this is all more transparent. The yield spread premium is now considered borrower credit and shown on a good faith estimate as an estimate to closing costs, directly as a credit, offsetting, again, subsidizing the borrower's closing costs, requiring them to bring less to the table. Hope that makes sense. This is Ed the Trainer. If you've got questions for me, just reach out. It's ed@edthetrainer.com. We'll see you around.